I'm going to introduce Trent. He is the managing partner of Red Cedar Wealth Advisors with 15 years. Oh, with 15. Oh, sorry. 15 advisors, sorry, and over 500 million in assets under management. Trent has 25 years of experience in the financial industry and holds a certified financial planner, chartered financial consultant, and accredited investment fiduciary designations. Trent is married with 3 children and loves to spend time in the outdoors when he's not helping us make money so we can retire early. And then we have sweet Alan. Kristen is a longtime volunteer at the museum, and Alan lets her spend time with us. And he is a CPA, retired. He spent his early years on the family farm in Weston, Idaho. He graduated from ISU with an accounting degree in 1972, and his first accounting position was at the, how do you say that? Touche Ross. I want to say touche. Okay. Touche Ross, national CPA firm in Boise, Idaho. He earned his CPA license in 74 and is still active today, although he is also actively retiring. Alan's experience and skills in auditing, taxation, and financial statement preparation have been exhibited in the company positions, held, as well as his own CPA practice. He has served as the CFO or controller for several Idaho Falls companies, including Martin Stationery, Wright Oil and Tire, and Conrad and Bischoff. His financial management and tax planning skills have assisted in growing and creating additional wealth for their owners. He is proud to have been married to Kristen for over 46 years, and they have 3 great children. Together, they are now embarking on a new era in their lives called retirement. And I just wanted to say, you know, one of my goals in this job is to help people give smarter, not just to the museum, but to everything they're passionate about. And so I'm excited to present this panel because I think this is a great way to get some free information.
There you go.
And so I'm going to just start off. I think we'll just sort of do a panel minus Jed. He's on his way. And I think what I'll do is just have you start by maybe introducing some of your best financial advice that you would give, and then from your perspective, year-end tax plan.
Oh, yes.
Okay. Yeah.
Okay.
For
So best financial tax planning. We're talking charitable, right? We want to focus on charitable.
Yeah. But also.
Okay. Well, so I think the thing that gets missed the most, or that we do the most, is something called a qualified charitable donation. So once you turn 73 now, as of 2023, just changed this year, you can give money. Well, once you turn 73, you have to give money out of your IRA, take money out of your IRA, called a requirement distribution. It's based on your age and the life expectancy table that the IRS has. And typically that money comes out and you're taxed on it. The IRS set it up to make you pay taxes on IRAs, 401ks, etc. But you can do a qualified charitable donation where you take that RMD and you can donate it directly to a charity. And the benefit is it counts as your RMD for tax purposes, but it doesn't count as income. So you're not trying to beat your standard deduction or itemize. It just goes directly to the charity. There are a few rules. You have to be 70 and a half. It's not for everyone. If you're under 70 and a half, you're not allowed to do a qualified charitable donation. That's probably where we spend most of our time dealing with most of our clients. It's the low-hanging fruit for donations to charities.
Right, and basically the benefit you have here, as far as this, that a lot of people don't understand, is a lot of people give to their charities. How to say, whether you're giving to your museum or to your church or whatever, if you give donations to qualified 501c3 organizations, when you hit that magic age of 70 and a half, you can actually start taking money out of your IRAs and doing this, what he's talking about, the qualified minimum distribution or charitable donation. And basically the benefit for that is, with the new changes in the tax law, less than 20% of taxpayers today are itemizing. It used to be everybody itemized deductions. So when you file your return, you're always taking and worrying about accumulating all the deductions you could get, to say, but they put in some really interesting regulations that, as far as when they amended the tax code, they got rid of the exemptions and they basically went to a standard deduction. And it made it so that most people, although they give to charity, they really don't qualify. It doesn't help them to reduce their taxable income. And this happens to be one of the quirks they put in the program, and it's more than a quirk, it's a great benefit, and it's there. And the thing that people don't understand is so if you have an IRA and your required minimum distribution, I'm just going to use a round number, and you guys could have a lot more or a lot less, but let's say you're required to take out $10,000 a year. Okay. Well, the problem that you have with that is that becomes all ordinary income. Say, welcome in. I would say, no, you're fine. I would say, but so what I talked to people about is they said, well, then I have to give the whole 10,000 to charity. And I said, no, you can divvy it up any way you want to divvy it up, and you can give to multiple charities. Say, so if you have a church contribution you're always making annually, I'd say here's this much. If you give so much to your museum or to your other charities, you can basically designate. You can say, oh, well, I'm going to keep 5,000 of taxable income. There's no, people have got kind of confused on it. Well, if I start it, I have to take it all or distribute it all. No, you can tailor it. And that's what these financial planners basically help people normally do, because they're usually controlling your assets. And there's some forms you do have to fill out, correct? How to say, but it's a great benefit that's out there. How many here in the audience, by show of hands, have done one from their IRA? Got a couple, okay. Have you heard of it before, or is this something new to you, or how to say? And I guess the other side of it is, how many of you make charitable donations? By a show of hands, okay?
Hopefully.
So we're hoping that, now take a look and see who doesn't know. That's the idea, we're here talking about money and how that we basically create a legacy to be remembered by those funds. So anyway, I kind of interrupted there, but go ahead.
No, I think you're set. I mean, that's the low hanging fruit. The only provision that I'm really aware of is that there's a limit of $100,000. Correct. So you can't go over that dollar amount. A year per person. So if you're married, it's actually 200,000. So, okay.
So I was just gonna maybe we'll let Jen give your credit.
Yeah, first off, I'm so sorry. I was planning on doing this. I just didn't have it on my calendar for some reason. So my name is Jed Bigelow. I'm a partner over at Hopkins Roden, just downtown here. And about a third of my practice is dedicated to estate planning. The next third is kind of small business advising and contract review and all those things regarding with that. And those two, as you can imagine, go back and forth between, or I have clients who go back and forth between those two kind of categories a lot. And then my third, or my last third of my practice is really just a hodgepodge of litigation type stuff. A lot of contested probates and contested trusts and stuff like that. But if I had to say what my real expertise was, it would be more on the estate planning side and small businesses. So, and I've been in practice for almost 10 years now. I started out as a government attorney and then joined Hopkins Roden about 5 years ago.
He's a good Rigby boy.
I am a Rigby boy.
So we had these gentlemen say like their best advice, like they're good for advice.
The top advice.
Gotcha. Yeah. Well, my top advice when it comes to estate planning is simplicity. All about simplicity. It doesn't matter if it's a trust or a will. When they get complicated and convoluted, that's when fights occur. And so whether it's a trust or a will, as long as you keep it as simple and straightforward as possible, makes it very difficult for fights to come out of that. And that goes for gift giving as well. You know, making and one of the things I recommend when making gifts is rather than give dollar amounts, because we don't always know what the full value of the estate's going to be at the time of death, is if we don't know that, then I recommend making percentages. You know, 5% can go to the museum, 5% can go to the Humane Society. And then that still leaves 90% to go to the kids or the grandkids or whoever else you've got interest in. But yeah, simplicity is what I'm all about. Whenever I have clients come in, I try to get them into the most simple plan that we can that accomplishes their goals, because anything that's complicated, in my experience, tends to end up in more fighting.
Can I jump in? So let's start out maybe with, there's really two levels of when you're doing charitable donations. So we were talking for just a minute about the estate tax. So if your estate's worth more, like 2023, if your estate's worth more than 12.9 million per individual, 20, whatever that number is, 25.8 million as a couple, then once you trigger that amount, you have an estate tax. And if you're over that amount, charitable planning becomes much more relevant because of the severity of the estate tax. Well, I think, well, you get to 55% very quickly. So
Yeah, it
it's like
starts at 40
something.
and goes up to 55, but it is a very quick jump. So
Yeah.
even $2 to $3 million over could easily be over $1 million in taxes. But
Yeah, and so when I first started in the financial planning industry in 1998, that exemption was $685,000, and people hit estate tax, and we were doing AB trusts and all sorts of things on a regular basis. When the estate tax went up to such a high amount, we're generally not doing a lot of charitable planning around estate tax purposes, because there's just not that many people who have estates over $25.8 million. So at that point, then charitable donations or charitable contributions really come down to, you, and are you charitable, and do you want to leave some money behind in the will? And that's Jed's department. Or if you're alive and you want to make donations, then I'm a huge fan of making it as tax efficient as possible to get the biggest bang for the buck. So just a couple other quick ideas. I like my charitable donations. A lot of times I'm giving appreciated stock. I could either take cash that I earn and give it to the charity and pay taxes and try to hit the deductions, or I can take stock that maybe has, or bonds or whatever that is appreciated significantly. I can give those shares directly to the charity and avoid the capital gains tax on that contribution, and then take the cash that I would have used to give the charity and repurchase that stock with a much higher cost basis moving forward. You want to add to that?
Yeah, there's only two things you have to really avoid on the stock side, and that is what's called a short sale, meaning that you cannot buy the same stock back within a 30-day period. Okay.
Only if it's
Well, I'll say, right, only, no, but it is at a loss, right?
no, if you give it appreciated stock, you can buy it back.
Right, you can buy it right back. If you donate it, the other thing, what I was going to try to say is, one of the things you don't want to do is give stock that has actually lost value, because you don't actually get the full value of your deductions. So never donate investments that have decreased in value to what your cost basis is to charities. You'll be better off to give cash, to say, and then go back to the tax planning ideas of basically recognizing your losses and taking the losses against ordinary income. Gifting, a lot of people find it somewhat difficult to gift security. So why don't you explain to them how they do that?
So if you're gifting securities, first of all, whoever your current custodian is, whether it's Schwab, Merrill Lynch, TD's gone now. If you don't know, Schwab bought TD. TD's now gone. But you get with your current custodian, and then, for example, let's say it's the Museum of Idaho. They have a custodian somewhere. They would have an account with one of the custodians, and you work with your advisor or your custodian. Basically, you get the account number from the museum, and you fill out some paperwork, and the shares transfer directly from your account to their account. And then they, as a 501c3 with they can sell the stock, not realize any capital, any taxes. And your deduction is the average of you have to take the high and the low price for the day and average that out and multiply it by the number of shares, and that becomes your taxable deduction for that contribution.
Right now, the museum is partnered with Free Will, and I don't know if you
I have looked at it.
had right now, the museum is partnered with Free Will, and through Free Will, it's accessible through our website. If you go to the donate and then you do planned giving, it takes you to, you can fill out your will, and if it's however complex it is, at least the format for that is it actually, for a simplified will, it will gather up all the information and then you just have to get it notarized. If it's more complex, it at least helps you gather the information and then take it to your estate planning lawyer, and then you have all the information you need. The other thing we do through the Free Will app is stock giving. So it helps you gather up the information. It gathers up all the information you need from our advisor too, and then you take it to your financial advisor. So you can go, if you wanted to do that for us, you could, it automatically generates that for you through our website. So.
Super slick, very tax efficient, great way to save some money on income taxation. Any,
So, sorry, going a little bit back to the estate tax conversation. I don't know if this got shared before I got here, but the current threshold is 25.8, somewhere around there. That's going to drop by half in 2025. And so I'm not going to ask who has over $12 million in assets here, but if you do, this is actually a prime time to do estate planning and take advantage of the current 25.8 million limit, because in 2025 that drops by half. So each individual is going to be around 6 to 7 million. For a married couple, it'll be, you know, the 12 to 13 million. And right now, everything I've read from the IRS says that if we get, if you're, let's say you're at the 19 million mark, so you're not up above the where it is currently, but you will be above it in 2025, we can pull that out of your estate now without penalty. The IRS will grandfather you into the current limits. So that's another great opportunity to set up estate planning that is charitable giving, because we can get that out of your estate, get you back below the estate tax threshold, and you can still hold on to that asset and let it grow. And or you can donate it now at any time, but you can let it grow and donate it at the time of your death as well. Just kind of a little heads up, if anybody's in that category, now's the time to go talk to an attorney and get that figured out before 2025 comes.
Let me ask the audience here. Say by show of hands, how many people there actually have? And for those of you who didn't raise your hands, there's a reason. One of the, I don't know, let him as attorney explain to you, why do you need a will in Idaho, or why should you have a will?
Yeah, really, really good question. So my response to that is always, I believe every client of mine should have at least 3 documents. First would be a will, which governs after your death, who's going to be in charge of paying off your debts, who's going to be in charge of distributing the assets, and then the will sets out where those assets go. If you don't have a will in Idaho, we fall under what's called intestacy. Now, in intestacy, in the traditional nuclear family, mom, dad, kids, if both parents die, it just goes to the kids. We live in a day and age where the nuclear family is not probably the most common anymore. We have families who have stepkids and second marriages and lots of different variations of family, and our intestacy rules are not geared for that. I've had quite a few cases where, you know, mom or dad got remarried, their spouse then died, and what they're entitled to is 100% of community property, but only 50% of separate property, and the other 50% of the separate property goes to the kids. So right off the bat, one of the surviving spouse may have to come up with a large chunk of money to pay the kids off. But the other thing too is it doesn't really protect the kids, because the kids get that 150% and then they don't necessarily have a claim going forward, right? So intestacy can get really messy, and that's what's nice about just having a will is you get to dictate what you want. And there is no gift giving in intestacy. It goes to your heirs. There isn't an opportunity to give gifts in that. So that's the other thing that wills provide, is an opportunity for you to give back and give charity. The other two documents I always recommend having is a durable general power of attorney. And the reason for that is if you're ever in a situation where you become incapacitated, whether it's a stroke or a car accident or something like that, this makes sure that your agent has the ability to be involved in your finances, pay your bills, collect your retirement, collect your income, collect your disability. They can even sue on your behalf, but that allows them to take care of you. The third document I recommend is what we call a medical directive. And there's a healthcare power of attorney, which is very similar to the financial one, ensures that your agent can make healthcare decisions for you. And the other part of that document is called the living will, which allows you to direct what kind of level of care you'd like if you're on your deathbed and unable to communicate. Most people I talk to don't want to be put on a ventilator and be artificially alive for a long time. And that is the default. Without a living will, doctors will keep you alive as long as possible until it's determined that they absolutely can't. And then they will let you go. But a living will lets you to kind of make those decisions yourself in advance so that you know what's going to happen.
Well, I've heard the comment from some of my friends and tax clients, well, I don't need a will because I really don't have a whole lot of assets. I mean, I'm living close to most of the funds are going to be gone by the time I die, so I'm not going to worry about it. And to them, I say, it's a document. It does cost you a little bit of money to get in place, but it can really benefit the people that you're leaving behind, and that's who you're really taking care of. What a will does is basically tell those who are left what you wanted done with what you have, whether it's your house, how to say your car, or whatever. Because if you don't like he's saying, and I'm not giving legal advice because I'm a CPA, and one of the things I cannot do is give legal advice.
You do have wisdom, though.
Just say, but I can tell you from experience that it really can get ugly because if there's no directive, the kids can be saying, well, dad promised me that I get this, and it can tear families. It can happen with the will too, but one of the things you can do in a will is you can make a directive or an attachment that says, I'll make a list of things that I want personally transferred. To say that this goes to this person, this goes to this person, this goes to this person. So there's a lot of pluses of having something in place that basically says, don't let the state take care of and create the hassle for those who are remaining. And the other side of that is the cost. That there are costs involved, aren't there?
There are. So whether you have a will or if you're intestacy, you kind of have to. In other states, I would say avoid probate. California being the main one that comes to mind. Utah's another big one. Because their probates are complicated and they're expensive. Here in Idaho, probate is about as streamlined as I've seen in any other state. And honestly, most of my probates that are not contested and are pretty straightforward are between $1,500 to $2,000. But whether you have a will or intestacy, you'll have to go through that. If you're looking to avoid probate, then the tool that we would move to next would be a living trust. Those are more complicated to set up, and so they are more expensive to set up. And there is also administration costs on the back end as well, but their whole purpose is to avoid probate. And so my default is to recommend wills unless I think there is a real need for a trust. And oftentimes I do have clients come in, and as we discuss, we determine that a trust is the best route. But going back to the original point, whatever the estate plan is that you come up with, I definitely recommend having an estate plan in place of intestacy, because with an estate plan, you get control. With intestacy, you have control. The state decides. Yeah. That That's absolutely correct. The only way that you can transfer real property after death is by getting a personal representative, the legal authority through the court to sign on your behalf. And so if you have real estate and you have a will, you're going to have to go through that probate process. If you have vehicles that you need to switch the titles over, someone has to be able to sign, and that's what probate's all about. What a trust does is when you set up the trust, you move all of those assets into the trust. So technically, when you pass away, you don't own anything. The trust does. And then the trust itself will have what's called a successor trustee who steps in and will have that authority according to the document. And that's how it avoids probate, is you essentially are giving up all your personal assets to an entity that carries on beyond your death. But both under trusts and wills, charitable giving is easy to do. It's really easy to do. It's as simple as letting your attorney know, how much, or if there's specific assets like stocks that you want to give after your death, just identifying what those are, and whether it's a trust or a will, we can make that happen.
I had a couple things. Not sorry on the charitable. When you do your estate planning and you visit your attorney, make sure you include your financial advisor. It's often overlooked, but financial planners actually do more estate planning than any attorney will ever do. I'm sorry, Jed, because they name all the designation, they name all the beneficiaries in all of your accounts, life insurance, IRAs, etc. And we don't care what the trust says or the will says. We don't. If you say I leave all of this money in my IRA to this one child, and the trust or the will says divide it equally, we ignore the trust and we give it all to one child. So you need to make sure that whatever you're doing with your attorney, your financial advisor knows what you're doing so that they can make the correct charitable donations. Another good example would say you want to leave 10% of your IRA to a charity. That's in your will. We don't care. If you didn't name the charity as a beneficiary on the IRA, it's not going to the charity. So you have to make sure you include your financial advisor in these discussions, because just because the attorney writes it doesn't mean that it's going to be. So
I'll just comment a little further on that, and that is that basically retirement accounts, which are 401ks and IRAs, basically actually don't go into the estate. They go directly to the beneficiaries. So what a lot of people don't
unless you don't name a beneficiary,
yeah,
then it
unless
goes
you
to-
then yeah, unless there's no beneficiary name, but anyone who's setting up any financial planner or anyone who's broker that doesn't set it up with beneficiaries, you shouldn't be working with them if they don't require you to provide one, because there has to be one. The biggest problem you have with a lot of people, he talks about keeping them involved, but when something happens, if you have a life-changing event, and I'll kind of flip this over to year-end tax planning. One of the things that we always ask clients is, that there been any significant event in your household that needs to be taken into consideration? Have you had children born, or you've had divorce, or anything that's significant that you need to take care of? And people say, well, there's nothing significant. I say I've had my 401k forever, and I say, well, who's the beneficiary on it? They say, well, I don't know, but however we set it up. Well, who are you married to then? Well, that was Dorothy, and I'm married to Gloria now. What happens in those cases, which is very unfortunate, is that when that person happens to die, if they haven't changed it, the money does not go to the second wife. It goes to directly to whoever the beneficiary is. And people have to understand that and make sure they keep those things up to date. I would say, as far as changing the documents or changing the things that have occurrences, let's say. And sometimes people set up things that they are very think they'll never have to change, but things do change sometimes, and you need to make sure you react to those. So,
Really good advice. This is more of a technical point. Idaho code does say a divorce will cancel beneficiary designations if it's your former spouse unless you reaffirm them. But that's a technical statute, and quite frankly, that just leads to fighting. It leads to fighting. I had a case that's been going on for the last year, and that's the exact issue. Is the decedent got remarried to his new wife, thought his divorce took care of everything. He's like, I don't need to change my beneficiary designations, and then he passed away. And we went to go get the Percy death benefit, and it had gone to the ex-wife. So we had to file a lawsuit, and it dragged out for a year, and ultimately we got it sorted out and fixed. But that's why working as a team is so vital, is to make sure those things are covered so we don't run into those situations that you're not thinking about. And I often work with CPAs and financial planners as we're going through the whole plan for that very reason. And sometimes I'll call the financial advisor up and I'll say, hey, we've got, this child's portion is going into a trust. Maybe it's a special needs trust. And then we'll need to change the beneficiary designation. We don't want it to go directly to the child. We want it to go to this trust that we're setting up. And we work together to make sure that that's done and set up right, so that those assets get where they need to be. But the other thing to remember too with these beneficiary designations is that's just one more way to avoid probate. If you have those down, like they said, it just happens. Usually you just have to show a death certificate, fill out some paperwork, and they'll issue new accounts to you and distribute the money. So for a lot of my clients, the bulk of their assets are in a 401k or an IRA. And that's a great way to dispose of most of their estate without even having to get to the will or the trust part. So anyways.
All right, let's get back to charitable because that's funner. Let's do that. Is that okay? Unless anybody has questions. Okay. So some other great ways to give to charity. If you have old life insurance that you no longer need, you can gift, in essence, that the value, gift the life insurance to the museum. A lot of times they would ask, I'm speaking for the museum, so they would ask that if the premiums need to be continued, that you would annually gift the premiums so that they can continue to pay that death benefit. And then when you pass away, you leave a much larger gift to the charity than you would otherwise by just giving a smaller amount. So that's a really common, pretty easy way to make a significant donation to a charity. Is, if you have an old whole life policy you've had for 30 years and you just don't have a need for it anymore, you can gift that policy to the charity. If your estates are larger, there's some really cool stuff that's just a lot of fun to work on. So if you do have estate tax issues, there's certain trusts that are specific to charities. So charitable lead trust, charitable remainder trust, that allow your beneficiaries to receive some income for some years, or receive some benefit, receive a tax deduction, but ultimately that money ends up with the charity. And it's probably a little bit too complicated to jump into here, but if you do have an estate tax issue, just know there's some really fun, I call it fun because I'm a little bit weird, estate planning that you can do that really still benefits your heirs, but also can have a major impact on charities, as well as make sure that you give the IRS as little or hopefully nothing at the end. So
Yeah. One of the things that I find it very interesting is when I started as a CPA and started working in the tax department in Touche Ross, we were working with clients and the top tax rate was 72% of income. That was how biased the tax court was. And that was how basically wealth was being, basically the wealthy were being taxed to pay for the benefits of all the others. We are now probably in the lowest percentage that the rich are paying on tax income that has been in existence since I've been a practicing CPA. The top rate is 37 point whatever. Okay, I'm not going to give you the fractions, and it can be an effective rate of 39 something when you tack on all the other little add-ons. But effectively, it reduced the amount of taxes that are being paid on wealth. Okay, to say, and it made it a much different ballpark as far as how you do your tax planning. Okay, we still have a whole bunch of tax shelters out there, people promoting, and one of the promotions that I saw, and I don't know if the museum has got caught up in some of these, but of people donating artworks, I'd say, and asking for way inflated values. But you can actually do donations. You can donate artworks, I'd say. It's just a matter of how much, who they say they're worth, and if it basically creates a tax benefit for you.
Give me a crayon and paper.
Yeah.
I will say this, with development, you don't ever value. If they want to donate something, they have to.
And you need to have a certified appraiser, okay? People say, what does that mean? Now, to say legally, do you want to address what that means?
Need someone who's got certificates and qualifications to do what they're doing.
Right.
A little shout out to my firm. If you're in the museum and heading into the out west portion of the museum, there's a giant circle picture of the Tetons. That was given to my firm by one of our clients who painted it as payment, and it did not fit in our office because it is ginormous. And so we're like, well, what's the best thing to do? And so we donated it to the museum. But that process was exactly that. We had to get a certified appraiser out to give us the value. We gifted it to the museum, and then we took the value from the appraiser, and it was a tax benefit for our firm that year. But really, those types of things are a great way to donate and give on assets that maybe you just don't need anymore, or if you're downsizing, like, I don't need this stuff, let's donate it to a charity. Yeah, so anyways, I'll give it back to you, but that was
Anyway, they say that the whole idea of what do you want to be remembered for, what you're doing with your legacy, and one of the things the museum is trying to provide for you is a vehicle that basically, if you support them or you want to take care of their programs or participate in them, they're definitely welcome with your donation and your participation. And say, what we're trying to do here is say, okay, is there some tax benefit to doing that? And there may be more tax benefit in the future if we go back to the old tax system that we had before the Tax Reform Act, because everything's going to sunset, and who knows about what's going to be in place. Because well, as stalemated as we are right now in our political system between our government, trying to get a new tax code replacing, because what happens is it's guaranteed sunset law, which says that it reverts back to what it was. Correct, legally? So we'll go back to exemptions, we'll go back to standard deductions, and we'll go back to a lot lower limits, okay? Which will basically say we may be having a lot more people itemized, which may make charitable giving even more of a tax benefit. So the future is never, there's two things that are always certain that you can always plan on, and that two things that are going to occur, and that is you'll always pay taxes, and you're always going to die. So they can figure out what you want to do or what you want to leave and how you want to leave them, I would say. And I think the idea here was just to give you some thoughts or ideas about ways of giving or donating to charity or to this charity.
About in Idaho, they have the Idaho education credit. Is that still for your Idaho state tax?
I'd say they have not changed it. Idaho has been, it's funny, they've been running congruent with the federal regulations. So what income is defined at, what your adjusted gross income is defined on the federal level, is basically the starting point for Idaho. And from there, Idaho takes and says, okay, we are going to provide certain other things. And some of those other things that they've done is they basically have some Idaho education credits. They have how to say, I'm trying to think about Idaho code, how to say, but they don't allow bonus depreciation for businesses. So you had add backs there. So it isn't, Idaho income and federal income are two different, are not always the same. Okay. But Idaho does have some of those provisions, and I really not an expert on Idaho tax. I haven't been doing that much with the credit. So I can't really answer your question, but I'm not aware that it's been taken away. It's still there, I would say. It's just like Idaho has medical savings accounts that you can set up and take a deduction for, which is a terrible program. You're a lot better to have a program if your employer has an HSA, a savings account, or a flex account, or something like that working. Those are better plans than having a separate medical savings account. Because the only benefit you get is basically the state tax revenue. And right now, the tax they've dropped the percentage of Idaho's tax percentage has dropped from, we were at 6, we're now at 5 and 5.8, something like that, of tax. What people don't understand, a lot of people, is people say, well, it must be really cheap to live in Idaho because you have such low taxes. Technically, Idaho is not a low tax state, which a lot of people don't understand. And the reason that they say that is that when you add all the taxes together, there's a lot of other states that are actually charge a lot less. But then we live in a beautiful state and we like to live here, so why would we not pay those taxes, right? I'm sorry, I couldn't answer your question.
Not to that point. I don't have any expertise in that, so I trust you on that. What I was gonna say is I agree for anyone who has a significant net worth, it is a lot of fun to do some charity giving and planning, because there are a lot of ways to do that, including charity remainder trusts that were mentioned already. But those are fun to set up and fun to kind of work through the details and find the beneficiaries that you really want to benefit from that. What I would add to that, though, is even if you're not a high net worth individual, any gift is still useful and helpful. And as I said at the beginning, for a lot of my kind of average clients who are maybe $1 million up to $2 million, there's not a ton of money, but they've got good resources, and they're entering into retirement. They're like, well, I want to give a sum of money back. And so a lot of times they'll come to me and they'll say, well, why don't we do 100,000 here or 100,000 here? And one of the issues that comes up is like, okay, well, what happens if you live until 100 years old? And you need to use these resources for your living, and we get to the end of this and you don't have the 100,000 to give, or the 100,000 is all you have left and you wanted to leave some to your kids, right? And so that's where simple planning with like percentages comes into effect. So even if you're not a super high value net worth, again, identifying a percentage of your estate that you'd like to go to a charity organization is a great way to do that, because whatever life takes you and wherever you go with that and how much you have at the end, you can say 10% is going to charity or whatever the amount is that you like. But there are really simple solutions, even for those who don't have high net worth, that we can address and make sure that we're still giving back to our community and the place that we live, while still providing for our kids and giving them some little bit of help as we pass on. Yeah.
I normally don't have it on my social, but I will in this case. I'm just advice on the next generation and stewardship, and you're right. There's a lot of people, and I have several clients who, I have one client out of Falls that's worth a few million, and she has no children. A lot of it's going to go to nieces and nephews from some of her siblings. But charity is a big portion of her estate plan, and she's already identified 4 or 5 charities.
Yeah.
This firm, Larry Larson, did her estate planning, and we put that in her wills, and it's a great place to go. I think one of the things is just having a conversation about what are the plans in the future, what do you want to really accomplish. We spend all of our lives accumulating wealth. Honestly, we don't do a very good job of decumulating wealth in retirement. We tend to not spend what we probably could spend early. And by the time we figure out we could spend a lot more, we're too old to spend it. And don't pick on you. And so, not that you want to die the richest person in the graveyard, but there's assets and they need to be planned for. And you can do a lot of good in the world. I think along those same lines, I have 3 kids. My net worth hopefully will be fairly decent by the time I hopefully die at 95 or whenever that's going to be. How much money do you leave your children? Is wealth a benefit or is wealth a curse? Sometimes it's a benefit, but a lot of times it's a curse, and then you have to, I think, consider your children's situation. I mean, unique planning for children who have challenges, who maybe have a drug addiction or alcoholism, or even worse, they have a spouse that you just absolutely can't stand and you're afraid of them getting divorced, and so all of those come into play. But I think for the next generation, if you have children who maybe aren't married or not having grandchildren, having that conversation of, you're going to inherit some money from me, and when you pass, I really love that money to end up here.
Yeah, so you could actually put it into a trust, whether you set up the trust while you're alive or we put it in the will, which is called the testamentary trust. You could put the child as the beneficiary of that. You could there's any number of ways to do it. You could set just a base amount that they get each month as a living wage. You could mark milestones that you want them to reach and they get payments. But then the residue of that trust at their death could go to a charity. And so there's lots of creativity that we can get for that, where you can still, and especially like what was said, if one of your children has a substance abuse problem, I always recommend giving their portion into at least a testamentary trust so that they don't get direct access to that and harm themselves. But one of the beneficiaries of that trust, especially if they don't have kids, could be the museum or any other charitable organization. But I agree, as far as the answer to your question, I think it's a matter of having that conversation. I have, every now and then I do have clients who come in who don't have children, and that's always my first question is, well, what do you want to do, and have you thought about charity? And what we typically do in that conversation is sit down and what kind of things are you interested in? What do you want to support? I always put a plug in for the museum because I've got ties here, and I love the museum, but there's lots of things locally, the art council, there's so many different options that you can do. And so having that conversation with them, because a lot of times clients come in and they haven't thought about that. And I'll just have that conversation and say, what are some things you'd like to promote in the community? Because we can do some good here, and you can still give to your nieces and nephews or whatever you want to do, but they're in a unique position to maybe give more because they don't have necessarily the same pull that we do when we want to give to children. So. I'm going to give you a lawyer answer, and that is, it depends. So yeah, bring it to me and pay me some money, and I'll tell you the answer. No, I'm just kidding. Yeah, it does depend. Is it a handwritten will? Okay. Okay. So Idaho allows for what's called a holographic will, which in order for that to be valid, it has to be in the decedent's handwriting. So you actually have to sit down and write it out and sign it. And if that's the case, that is not necessary to have witnesses or notary if the whole thing is in your handwriting. Now, I would caution against that It does need to be dated. Yeah, I would caution against that because that is a ripe situation for someone to come in and be like, that's not mom's handwriting. You know, now we have a fight over what does mom's handwriting look like? And mom's handwriting was really messy at the end of her life, you know, right? Right. So to answer your question, yes, you could. I don't recommend it. So in your case where you've got it on a Google Doc or maybe you're using free will, in order for that to be valid under Idaho code, you have to have 2 witnesses and it does need to be notarized. They actually can, but I recommend that they don't. Now on the living will, they cannot be. There is specific requirements that for the medical directive that they cannot be relatives, but on a will they actually can, but I don't recommend, especially if all of it is going to one particular person and they're the witness, that creates problems as you can imagine. But when we do will signings in my office, I'm a notary, and so I usually notarize all of my documents, and then I'll bring in 2 assistants to be witnesses who have no relation to the clients, and that's a good way to do it. And so with your case, honestly, I would offer you to come into my office and I'll review it and notarize it for you. I don't typically charge if that's all we're gonna do. I can give you a quick review and notarize and go on your way. That is correct. Yes. Yeah. And so in this day and age, a lot of things that we do are electronically signed. And a lot of my business on the business side of transactions, we do electronic signatures, right? When it comes to estate planning, it's one of the few areas that electronic signature is not acceptable. It has to be a actual pen to paper signing. Now, one thing we can do is I am set up to do remote notarization. And what that is we have a video conferencing program that allows them to be in a different state and sign while I witness it, but then they have to mail the originals to me to finalize that process. So there is some ways around it, but yeah, that's just something else to keep in mind is you can't just electronically sign something. You've got to actually put pen to paper. Yeah. Yeah. Okay. Yeah. So like I said at the beginning, my personal philosophy is I default to wills just because I think they are simpler for my clients to manage over the long run. That being said, what we do in a will is we will obviously name you, identify a spouse, identify any children, and get the family identified. Then the next step that we do is we appoint a personal representative. So who's going to be in charge of managing your estate after death? And then the last thing we do is we go through and say, okay, where are the assets going to go? Obviously, there's more to it, but that's the basic gist of a will, right? You sign it, it's witnessed, it's notarized, and then you can put it in a drawer or in my vault. And what I usually tell clients is every 5 years or so, pull it out, make sure it's still in line with your wishes, make sure your representative is still alive, they haven't passed away. But otherwise, you don't have to do anything. And then at the time of your death, we'll take it through probate and take care of everything. With a trust, we set it up very similar. The documents have a lot of the same language in there, and a lot of the same parts. Instead of a personal representative, we'll have a successor trustee. And then what happens with the trust after you sign it is instead of just putting it in a drawer, you have the next step of funding the trust. And that's where we go through and we move your house deed into the trust. We move your vehicle titles into the trust. Your checking and savings account we move into the trust. With investment accounts and retirement accounts, I don't recommend using or changing ownership over because there's tax consequences, but you can use those beneficiary designations to either give it directly to the kids or have it come into the trust if there's like a special needs trust or a child who has an addiction, we would have their portion come through the trust to cover that. Yeah, and with a lot of your standard bank accounts, you can do PODs.
You can do it non-qualified brokerage accounts.
Perfect. So anyways, there's more to the process where you then move everything into the trust, so that at the end of the day, your name should not personally be on any asset. Or if it is, you have PODs or beneficiary designations that also avoid probate. So a living trust in of itself does not have any tax benefits, and it doesn't have any liability protection either. All it really is a tool to avoid probate. Now there are trusts that we can set up that do have tax benefits, and there are trusts we can set up that do have liability protection. But that's not your standard living trust necessarily.
Can I add a couple things
Yeah.
real quick? So real quick, what I see is you go to the attorney, you set up the trust, it's great. Maybe you fund it, maybe you actually change all the titles. But then you sell your house, you buy a new house. The new house doesn't end up in the trust. You sell your car, you buy a new house, new car, you change your bank accounts. So the challenge with trust is you have to stay on top of it. You actually have to make sure that the titles, because if you change your bank, sell your house, whatever, and you pass away, all those assets have to be probated to be put in the trust. The other thing, and I'm just going to mention this, probate is done by what's called situs. It's where it's located. So if you have assets in Idaho and you have a house in Arizona, there's two probates, the Idaho probate, the Arizona probate. That's where trusts really are helpful, because you don't have, if the trust owns the house in Arizona, there is no probate. So really for me, where I generally, I'm not an attorney, but we do make some guidance, if you will. If you have assets in multiple states, a trust probably makes a lot of sense. And if you have children who have challenges, a trust probably makes sense. You could, I'll let the.
Yeah. No, and that's the exact advice I give. That is one of the areas where if you do have real estate in more than one state, that's when, to me, a trust makes more sense. But to answer your question, you could. I have a client right now who has property in Utah and has put those properties into a trust, but has chosen to keep the property in Idaho under the will. I'm not entirely sure why they chose that. I actually inherited this client from Larry Larson. And so I'm sure there was discussions beforehand as to why that was. And we've made some adjustments over the years, but we've kind of kept that structure the same because that's what they want. So you can do that. You can also put Arizona property into your Idaho trust. There's nothing wrong with that at all. And it just means that Idaho law governs the governance of that trust. So really good question. Yeah. So a living trust, and the CPA could probably answer this better than I can, but a living trust typically is a pass-through. And so it doesn't have its own tax filings unless it becomes revocable, which most living trusts become revocable at the time that both spouses have died. And so from that point on, the trust would have tax liability. But in most trusts that I set up, it's not any different than your personal taxes while you're alive.
What some voters were voting is that they could set up trusts, put your assets in it, and you're never going to pay income tax again. And that just doesn't happen. It's not out there. I'll just say, somebody's going to pay the tax on the income they receive. But it just, I'll just say, putting it in a trust won't say, well, the trust isn't taxable, so they don't pay tax. So then the income's in the trust, so I won't have to pay tax on it. That doesn't work, and that's not out there. So people they've promoted some of these trusts that way, and some of the people here trust says, and they have a bad connotation because of a few bad apples that have done some promoters. But trusts definitely have a place for people who have assets in multiple states, which is what the guys are saying. I just say, but the last thing I wanted to encourage you is for those here in the room, look at those of you who are taking required minimum distributions. So we started the first of the session. Look at it and see, is there a benefit of giving? If you want to give to charity, take advantage of the tax savings that you can have by taking a direct contributions and the qualified benefit, let's say, coming out of your required minimum distribution. And if you're giving to a charity, that's the best way to do it, because you save taxes and you don't pay income tax on it. So,
Okay, I'm gonna add one more thing that okay, so if you have any significant assets you're planning on selling, family farm, business, etc., it's a great time to do it. Some charitable planning. You can greatly reduce your tax liability. And like that's where a charitable lead trust might come in even before you pass away with the sale of a business or something, or in the case of farm grounds or another asset, you may give some of that to the charity before you sell it and don't have to realize the capital gain on those on that sale or a portion of that sale. So if you just have a life event where something's coming up, consult your CPA, consult your financial advisor, consult your tax advisor or your attorney, because there are some ways to greatly reduce your tax. Like for me, that's a lot of what this is about. I hate giving money to my uncle who has his hand in my pocket constantly. I'm trying to get his hand out of my pocket and keep as much of it as I can for myself. So.
That the tax or the state tax will be passed.
Yeah, so
No.
back to the sunset conversation, the
Right.
current estate tax will sunset 2025.
But money in the IRA money. Distributed securities, does that bring down the rent taxable amount? Or does it be regular state?
An IRA is included, and so shared,
If the IRA, beneficiary of the IRA, for the charity. Then it's not-
right, yeah, that's what I'd say. So
Yeah.
the IRA is your IRA balance is included in the total estate amount as to whether or not estate taxes apply. But if the beneficiary is a charitable organization, you can, that part is not taxable and you can lower your
Both of
estate.
them.
Both what are added together.
So say I have 3 million in an IRA
Mm.
and say I want to give them want to pay taxes. I mean, the IRA goes to charity.
Yeah, you could give the total IRA to charity and that would drop you to just 10 million at that point.
So that's
Yes. Mhm.
unfortunately.
Does anybody have any more questions? We're at 4 o'clock now. I really want to respect your time so much for coming. You guys really don't want more
So
questions.
what's the deadline for doing this?
For R&D or?
RMDs have to be out by December 31st.
Like,
So if you haven't taken your RMD, then
if they give it to you before that.
so if you've already taken your RMD, there's really nothing you can do. You can't back it out. You can't put it back and take it back out. It's out.
So you have to plan it. for the next-
So you'd have to plan it for the next year.
Right, but say, don't go in and be your financial advisor on December 31st, they want an RMD. You need to make sure you schedule it. Say, the other side of RMD that most kids want to consider is what type of federal withholding, and you want to take in, have a tail on it, so to avoid having estimated penalties for underpayment. Have a whole bunch of juries. So,
I will say,
Accountant
so
can tell you.
by December 15th,
yes.
Good. year end is extremely busy for Hopkins Roden, Maryland, everyone. Everyone's trying to
Attorneys
do-
as well are super busy.
Yeah, everyone's trying to get their tax planning done at the end of the year. Generally speaking, if your paperwork's not in by December 15th, there's a good chance it won't happen. And as sorry as they are, it's not their responsibility. And so, yeah, if you're looking at doing RMDs, qualified charitable donations, I recommend October, November, you get it done and be done so that you can enjoy Christmas and not have to worry about it.
Any closing remarks?